You know what separates people who build real wealth from people who just watch wealth get built? Information. Not the kind of information you get from headlines or social media panic posts. I'm talking about the kind of information that makes you sit back and say, wait a second, nobody else is connecting these dots. And that's exactly what we're doing today, because what I'm about to walk you through isn't just about silver, it's about understanding how markets really work when the system gets stressed. And more importantly, it's about you making smarter decisions than 95% of people out there who are either frozen by fear or blinded by greed. It's Friday, February 20th, 2026. Silver just closed at $84.52 per ounce, up 7.77% for the day. For the entire week, silver gained roughly 9%. Now, most people see that number and they either think, oh great, I missed it, or let me jump in before it goes higher. Both reactions are wrong, because what matters isn't what happened, it's why it happened and what happens next. And here's the part that should make every single person watching this pay very close attention. China, the world's largest physical silver buyer, was completely offline this entire week. Shanghai Gold Exchange, closed. Shanghai Futures Exchange, closed. Lunar New Year holiday. The biggest player in the room wasn't even at the table. So let me ask you something, and I want you to really think about this. If the price of silver went up 9% without the largest buyer participating, what do you think is going to happen when that buyer comes back? Because Shanghai reopens Tuesday morning China time. That's Monday night Eastern time for those of us in the States. And here's where it gets really interesting. During the holiday, while the exchanges were shut down, physical silver in China was trading hands at $93 per ounce, not 84, 93. That's an $8.48 premium over where Western futures closed on Friday. And when you see that kind of price disconnect between the world's two largest silver markets, you're not looking at a small technical blip, you're looking at a fundamental crack in how the market is functioning. Now, before we dive deeper, let me get the legal stuff out of the way because this matters. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I don't know your financial situation, your risk tolerance, your investment timeline, or your goals. What I'm giving you is information, data from public sources, exchange reports, warehouse documents, and market transactions. What you do with that information is 100% your decision. You're an adult. You're responsible for your own choices. And if you're going to make investment decisions, talk to a licensed professional who can look at your specific situation. That said, what I can do is show you how to think about this data, how to analyze it, and how to ask the right questions so you're not just another person getting swept up in market hysteria. Because here's the truth. Most people lose money not because they make the wrong bets, but because they make emotional decisions at exactly the wrong time. And the only way to avoid that trap is to understand what's actually happening beneath the surface. All right, let's talk numbers, real numbers, the kind that institutions are looking at right now. COMEX silver registered inventory, that's the physical metal available for immediate delivery against futures contracts, is sitting at approximately 103 million ounces. Back in October 2025, that number was 167.7 million ounces. Do the math. In 4 months, COMEX lost 64 million ounces of deliverable silver. That's a 38% decline. And this isn't slowing down. On February 11th, a single day, the warehouse report showed a drop of 3.25 million ounces in the registered category. 3 million ounces disappeared in one day. That's not a rounding error. That's a statement about what sophisticated players are doing with their positions. Meanwhile, March 2026 silver futures, the next major delivery month, have open interest representing 429 million ounces. So here's the math that nobody in mainstream financial media wants to talk about. COMEX has 103 million ounces of deliverable metal. There are contracts for 429 million ounces. That's 24% coverage. Think about what that means. If 1 out of every 4 people holding a futures contract says, I want my silver, the system gets very tight, very fast. Now, historically, most months only see 12 to 15% of contracts stand for delivery. Most people roll their positions forward or close them out for cash. But here's the problem. February 2026 just recorded a 98% delivery rate. Out of 19.11 million ounces of open interest, 18.72 million ounces stood for delivery. January, which is typically a quiet month, saw 49.4 million ounces delivered. That's a record. Let me put this in perspective so you understand why this matters. In all of 2024, total COMEX silver deliveries were 202.7 million ounces. In 2025, that number jumped to 474.4 million ounces. That's a 134% increase in 1 year. And we're only 2 months into 2026. Do you see the trend? This isn't speculation. This isn't some guy on the internet making predictions. This is official exchange data showing you that the people who actually have money in the game are taking physical delivery at rates we haven't seen in decades. Now let me shift gears for a second because I want to talk to you, the person watching this, not as some abstract market participant, but as someone who's trying to make intelligent decisions in a world where the rules seem to change every 5 minutes. Here's what I've learned after watching markets for years. The biggest opportunities and the biggest risks always show up at the same time. And they always show up when the majority of people are either too scared to pay attention or too greedy to think clearly. Right now, most people are in one of three camps. Camp 1, they have no idea any of this is happening. They're watching Netflix, scrolling Instagram, living their lives, and that's fine. Camp 2, they've heard about silver going up and they're thinking about jumping in, but they're paralyzed because they don't know if it's too late or if it's going to crash. Camp 3, they're all in. They've convinced themselves that silver is going to the moon and they're leveraging themselves to the hilt because this is their retirement plan. All three of those camps are missing the point. The smart play is not to be fearless. It's not to be paralyzed. It's to be informed. It's to understand what's happening, assess the risks and opportunities, and make decisions based on logic rather than emotion. So let me give you the logic. Right now, you have a physical market in China showing massive demand. Shanghai exchanges are carrying decade-low inventories, not year-low, decade-low. Before the Lunar New Year break, Shanghai spot silver was already trading at $86 per ounce, $2 above COMEX. During the holiday, physical buyers in Shenzhen were bidding $93 for 9999 pure silver. That's not a rumor, that's a documented transaction from one of the largest silver recyclers in the country. And an $8 premium is not normal. During the COVID supply chain crisis in 2020, premiums hit about $8. We're at that level now, and this isn't a pandemic. This is just supply and demand. Meanwhile, on this side of the Pacific, you've got COMEX registered inventory dropping like a stone. You've got delivery rates spiking to record levels. You've got institutional investors pouring billions into silver ETFs. On February 2nd, iShares Silver Trust, ticker SLV, recorded a $3.4 billion inflow in a single day. $3.4 billion. That's not retail investors buying 10 ounces here and there. That's institutional money, pension funds, hedge funds, sophisticated players who have teams of analysts and risk managers telling them that silver needs to be in the portfolio right now. Sprott Physical Silver Trust, PSLV, is trading at a premium to its net asset value, which means people are willing to pay more than the silver is worth just to get exposure through that fund. That's a scarcity signal. And then you've got the technical indicators that most people ignore because they're not as sexy as price predictions. Silver lease rates, the cost to borrow physical silver for short periods, are running at 8 to 12% annually right now. Normal levels are 0.3 to 0.5%. That's a 20 to 40 times increase. What does that tell you? It tells you that people who own physical silver don't want to lend it out because they either think it's going to be worth more soon or they're worried they won't get it back. And the futures market is in backwardation, which means near-term contracts are trading at higher prices than contracts that settle months from now. That's the opposite of how it's supposed to work, and it only happens when there's immediate demand that exceeds supply. So now you've got all these data points. Chinese demand is screaming. COMEX supply is draining. Institutional money is flooding in. Lease rates are elevated. Backwardation is present. And Shanghai, the epicenter of global physical silver demand, is about to reopen after a week of being dark. Now here's where I want to talk to you about mindset, because data is only useful if you know what to do with it. There are 4 things you need to watch over the next 72 hours, and this is where the difference between smart investors and everyone else becomes crystal clear. Smart investors don't react, they observe. They don't panic, they prepare. And they don't make decisions based on what might happen. They make decisions based on what the data is actually showing them in real time. First thing to watch, COMEX registered silver inventory. The warehouse reports update regularly. You can find them on the CME Group website. If that number keeps dropping, it means physical demand isn't letting up, and March delivery could get very interesting. If it stabilizes or starts climbing, it means some pressure is coming off. You don't need to guess, you just need to watch the data. Second thing, the roll pace from March to May contracts. Monday is the last full trading day before delivery mechanics tighten up for March. Watch whether traders are rolling their positions forward to May or holding their March contracts. If they're rolling, it suggests they're not interested in physical delivery, and the pressure moves to May. If they're holding, March could see real stress. Again, you don't need to predict, you just need to observe what's actually happening. Third thing, Shanghai's opening price. When Shanghai opens Tuesday morning, the first silver fix is going to tell you a lot. If it opens well above Friday's COMEX close of 84.52, that confirms Chinese buyers are willing to pay up and the premium is real. If it opens near or below COMEX, maybe the holiday premium was an anomaly. Let the market tell you the answer. And fourth, watch whether Western futures can break through $90. 90 is a major psychological level. If silver breaks it and holds, momentum buyers and algorithmic systems could pile in and accelerate the move. If it fails at 90 and pulls back, that tells you resistance is stronger than the bulls hoped. 4 data points, 4 things to watch. No predictions, just observation. Now let me talk to you about something that most market commentators won't tell you because they're too busy selling courses or newsletters or trying to get you to click on the next video. The truth is, nobody knows exactly what's going to happen. Not me, not the big banks, not the smartest traders on Wall Street. Markets are complex, adaptive systems with millions of participants all making decisions based on their own information, incentives, and emotions. And trying to predict exactly where price is going to be on a specific date is a waste of time. But here's what you can do. You can assess probabilities, you can understand risk, you can position yourself so that you're not betting everything on one outcome. That's how professionals think. They don't ask, will silver go to $100? They ask, what's my downside if I'm wrong? What's my upside if I'm right? And does that risk reward make sense given what I know? Let me give you some context from the institutions because this matters. JP Morgan's commodity team forecasts silver averaging $81 per ounce in 2026. That's more than double where it was trading for most of 2025. Their reasoning is industrial demand from solar panels and electric vehicles, plus investment flows as an inflation hedge. Goldman Sachs is more aggressive, projecting $85 to $100 on average. They're citing supply deficits that are expected to persist for a sixth consecutive year. Bank of America's base case is $56 with peaks near $65, but their head of metals research, Michael Widmer, has put out an extreme scenario of $309. Now, before you dismiss that as clickbait, understand what he's actually saying. He's not predicting $309. He's saying that if the supply deficit continues, if COMEX faces serious delivery stress, if industrial and investment demand stays elevated, then the mathematical path to 300 exists. Is it likely? Different question. Is it possible? Apparently yes. And then you've got people like Peter Schiff who've been pounding the table on precious metals for years. His target is $100 for silver in 2026. Whether you agree with his broader economic views or not, the point is this. There are credible, well-informed people across the spectrum from major banks to independent analysts looking at the same data and saying something unusual is happening in silver. Now, does that mean you should run out and buy everything you can get your hands on? No. It means you should pay attention and think for yourself. Let me address the elephant in the room because I know some of you have heard the narrative that COMEX is going to default in March and silver is going to explode to the moon. I need to be very clear about this. A full-blown COMEX default where they shut the doors and declare they can't deliver any silver is extremely unlikely. Mike Maloney from Gold Silver did an excellent breakdown showing that a lot of the viral math claiming 98% delivery rates was based on a misunderstanding of how open interest works. He calculated the default probability at around 0.001%, 1 in 10,000. But here's what he also said, and this is the important part. He said that if a high percentage of contracts did stand for delivery, even under the most generous assumptions, COMEX wouldn't have enough metal. So an outright bankruptcy-style default? Probably not. But a stressful delivery period that requires emergency measures like higher margin requirements, position limits, contract modifications, or even coordination with other exchanges to source metal, that's a real possibility. And that kind of stress creates volatility, uncertainty, and opportunities for those who understand what's happening. Here's the thing about market stress that most people don't understand. It's not the end of the world, it's information. When a market gets stressed, it's telling you that the current price doesn't reflect reality. And when price doesn't reflect reality, eventually something has to adjust. Either price has to move to reflect the fundamentals, or the fundamentals have to change to justify the price. Right now, the fundamentals are screaming physical tightness. Shanghai is paying $93. COMEX is trading $84. That spread can't exist forever. Either COMEX price moves up or Shanghai price moves down, or something in the system breaks and we get a new pricing mechanism entirely. Any of those outcomes creates opportunities if you're paying attention and prepared. Now let me talk to the people who are sitting on the sidelines thinking, this sounds interesting, but I don't know if I should get involved. I get it. You don't want to be the person who buys at the top and loses money. You don't want to be the person who jumps in out of FOMO and then watches it crash. Those are legitimate concerns. But here's what I want you to understand. Sitting on the sidelines is also a decision. It's a decision to let inflation erode the purchasing power of your cash. It's a decision to miss opportunities because you were too cautious. Now, I'm not saying you should be reckless. I'm saying you should be strategic. If you believe the data supports the idea that silver is underpriced relative to physical demand, then maybe you allocate a portion of your portfolio, an amount you're comfortable with, to silver. Maybe that's 5%, maybe it's 10%, maybe it's 20%. That depends on your risk tolerance and financial goals. The point is you don't have to bet the farm, but you also don't have to sit on your hands. And here's the other side of the coin. For those of you who are already all in on silver, who've been stacking for months or years, who are convinced this is your path to financial freedom, let me give you some tough love. Being right about the direction is not enough. Timing matters. Position sizing matters. Risk management matters. I've seen people who were absolutely correct about a market thesis lose money because they over-leveraged themselves or they held through a correction that wiped them out even though the long-term trend proved them right. So if you're heavily invested in silver, make sure you're thinking about scenarios where you're wrong or where you're right, but it takes longer than expected. Make sure you have liquidity, make sure you're not betting money you need for rent or bills, and make sure you're not letting confirmation bias blind you to risks. The market doesn't care how convinced you are. It's going to do what it's going to do, and your job is to manage your exposure intelligently. Let me talk about the industrial side for a second because this is critical and often overlooked. Silver is not just a monetary metal or a speculative trade, it's a strategic industrial commodity. It has the highest electrical and thermal conductivity of any element. It's used in solar panels, electric vehicles, electronics, medical devices, water purification, the list goes on. Global solar installations alone require about 650 million ounces of silver annually. Electric vehicles use 25 to 50 grams per vehicle. And as adoption of these technologies accelerates, industrial demand is not optional, it's structural. Now, Reuters reported in February that solar manufacturers are trying to cut silver usage because the price has gotten too high. Silver paste for a solar module went from $5 in early 2025 to over $17 now. So they're developing copper alternatives and reducing silver content per panel by 15 to 20%. But here's the key. That transition takes years. It requires R&D, testing, retooling factories. In the short term, 2026, 2027, the industrial demand is still there. And if anything, the fact that manufacturers are scrambling to reduce silver usage tells you how tight supply actually is. So, where does that leave us? Friday, February 20th, 2026. Silver at 84.52. China offline all week. Shanghai reopens Tuesday. COMEX inventory down 38% in 4 months. March open interest at 429 million ounces against 103 million deliverable. Physical premiums in China at $93. Lease rates elevated. Backwardation present. Institutional flows pouring in. Major banks projecting significantly higher prices. Industrial users desperate to reduce consumption because it's too expensive. And you sitting here trying to figure out what it all means for your financial future. I'm going to tell you something that might sound strange coming from someone making a video about silver. Your financial success is not going to be determined by whether you buy silver or not. It's going to be determined by whether you develop the ability to think clearly, analyze information, manage risk, and make decisions based on logic rather than emotion. Silver is just one opportunity. There will be hundreds more over your lifetime. The skill that matters is learning how to evaluate those opportunities, how to position yourself intelligently, and how to avoid the mistakes that wipe people out. That's the real game. And if you can master that, it doesn't matter what happens with silver or gold or stocks or real estate or crypto or anything else. You'll be fine because you'll know how to adapt. So here's what I want you to do. First, watch those 4 data points I mentioned over the next 72 hours. COMEX inventory, roll pace, Shanghai's opening price, the $90 level on Western futures. Don't predict, observe. Let the market tell you what's happening. Second, think about your own situation. Are you overexposed, underexposed? Do you even have exposure to commodities in your portfolio? Is that something that makes sense given your goals and risk tolerance? Third, turn off the noise. Stop listening to people who are screaming about the end of the world or about guaranteed riches. Those people are selling you something, either their products or their ego. Focus on the data. Fourth, make a decision. Not an emotional decision, not a knee-jerk reaction, but a thoughtful, deliberate decision based on what you know and what you're comfortable with. And then execute that decision and move on with your life. Don't obsess. Don't second guess. Don't let the market consume your mental energy. Make your move and live your life. And here's the last thing I'll say before we wrap up. If you found value in this, if you appreciate the fact that I took the time to walk through the actual data, the warehouse reports, the delivery numbers, the lease rates, the institutional positioning, all of it without just screaming at you to buy or sell, then stick around for what comes next. Because Tuesday, I'm coming back with an update on what actually happened when Shanghai opened. Did they gap up? Did they gap down? Did COMEX follow? Did we see volatility or calm? I'll have the answers, and I'll walk you through what it means. And if you're serious about understanding how markets work, not just following the herd, but actually knowing what's happening beneath the headlines, then you'll want to see that follow-up. In the meantime, I'm genuinely curious. What's your take on this? Are you expecting silver to move higher on Tuesday? Are you thinking it's overblown and we're due for a pullback? Are you holding physical metal ETF shares, or are you just watching? Drop a comment below and let me know. I'm going to be reading through them and responding over the next couple days, and honestly, some of the best insights I get come from the community. So share your thoughts. And if you know someone who's into markets, someone who's trying to make smarter financial decisions, someone who would benefit from seeing information laid out like this instead of the usual hype and panic, share this with them, because the more people who understand what's actually happening, the better decisions we all make as a community. That's it. Thank you for your time. Thank you for your attention. And thank you for being someone who's willing to think critically instead of just reacting emotionally. That puts you ahead of 95% of people already. I'll see you Tuesday with the follow-up. Until then, stay sharp, stay informed, and make good decisions. Take care.